Hey, good morning, everyone. Marty Mazzora here, 13th of July, 2019. This is going to be this week's weekly message, and I'm going to keep it short for you this weekend. We're not going to go through the price charts like we normally do. Just did that day before yesterday, and nothing really has changed in what I see as key technical indicators. Okay, so on your screen, you see PWA macro index. Last evening, I scored our own proprietary system here, which I do every week. And it came in at a 19.05, as you can see right here. And I just wanted to kind of show you kind of the character of our index right now. So we have live charts on all of these data points. So when they change, we know it immediately. So we break things down in sections: consumer, business, what I call general economy, inflation, commodity trends, and then all of this adds up to the economic subindex. Then we track financial stress, and this shows up in the debt markets. So we have what we call our financial stress subindex, and then the financial markets index, which covers everything from sentiment to where futures traders are positioned, to various volatility indexes, put call ratio, how options traders see the world, and so forth, how different sectors are tracking relative to the overall market, bonds relative to stocks, staple stocks relative to discretionary stocks, and so forth, valuations, and then breadth, very, very important. So it's important, number one, of course, to score the overall index, and then to see where the scores are coming from, the character, if you will. So we jump back up here to the consumer. You can see there isn't any red. There's some yellow. I have kind of call it maybe a subscore down here. It's just basically scoring one for the positives and taking one off for the negatives. And in here, essentially, we have a score of 50, which is a good score. What's been concerning me, and you've been sensing this from my tone on the blog, is really how business in the United States, and there's some global aspects of this as well, but how that looks. Business sentiment has been waning of late. We had a lot of optimism last month among small businesses. That's been waning a bit this month. Capital expenditure plans on behalf of small businesses absolutely plummeted last month. Industrial production looks sketchy. Durable goods, we're going to get this next week, and that had been rolling over as well. Transportation, not quite as bad. Corporate financing gap means essentially corporate earnings relative to what they're spending on CapEx means they do have earnings to spend, although I will say the corporate debt loads have really jumped over the last few years, and that's something we're going to be exploring as we get closer to the next recession. Commercial and industrial loans got a little bit better. They were in the red last week and so forth. Truck tonnage absolutely rolling over. Rail traffic looks very poor as well. So this should concern us. That's to what degree do we have goods crossing the roads and the rails in the U.S. Chemical activity, early manufacturing supply chain stuff, almost moved that into the red. It still looks very cautious to me. Caterpillar global sales have been waning a bit, and the global PMI continues to drop. So a negative 10 on the business side, that is not good at all. So that tells you that we've got some real deterioration in business conditions here of late. General economy, the Atlanta Fed does a GDP right now calculation. It's been dropping. 1.4% growth is what it's come down to. Remember, the economy grew at 3.2% in the last quarter. We're going to get real GDP numbers, one reading of that this Friday. Leading indicators versus coincident indicators, that's flattening out. That tends to roll over before each recession, so it's got kind of a flattish look. Now, this is the third time it's flattened out during this expansion, so it doesn't mean we're ready to roll over, but it's something worth coloring yellow. The Chicago Fed National Activity Index doesn't look good to me. And then the surprise indexes. This is how has the economy actually performed relative to economists' expectations 3 months earlier. The U.S. still pretty deeply in the red, although it's been improving. It gets above 0, I color it yellow. It gets above 10, it turns green. Eurozone looks a little better than the U.S., or it has been scoring a little better. Japan has jumped a bunch, so we've got good news from Japan of late, notwithstanding those machine tool orders, which were concerning that I showed you last week. China underwater, emerging markets underwater. Now again, underwater, not in recession, but relative to what economists expected to happen as recently as 3 months ago. Inflation, we did see a pickup in the CPI, a little bit above expectations, not enough to get super worried about, apparently not enough to concern the Fed. Clearly, they're planning on lowering interest rates at the end of this month. And then commodity trends, little improvement in the commodity index among Bloomberg. That almost turned green, but not quite. Raw industrial still lower than you like them. Copper improved just a bit. Baltic Dry Index has been fascinating to me. It's almost soaring higher. That's the cost of shipping dry bulk goods across the world's oceans. Those costs go up, that suggests there's a demand for those commodities. So we should begin to see that in commodity prices. One of two things is going to happen. Commodity prices are going to rise, or the Baltic Index is going to roll over and start moving lower. Financial stress, hugely important. The 2-year Treasury Fed Fund spread is not looking good. It's rolling over. The TED spread is the 3-month LIBOR rate versus the 3-month T-bill. It's looking concerning as well, a little better than the last one. The yield curve is yellow. The 3s, 10s, 3-month versus 10 years, that's inverted. The 2s, 10s, it is not near inversion. Typically, for my purposes, I want to see them both inverted before I start screaming recession. We haven't had that scenario yet. In fact, the yield curve's been steepening a little bit of late. Swap spreads not look attractive to me. Real important though, the high yield spread, junk bonds rates over quality bonds is tight. It actually got a little tighter. That's very positive for financial conditions. The Chicago Fed Conditions Index is a stress index. St. Louis Fed Stress Index, Kansas City Stress Index, Merrill Lynch Stress Index, and global credit default swap spreads are very tame. So this actually looks good to me, even though it scores a 4, which again would be the positives minus the negatives, or a 40. This to me still makes me feel relatively sanguine, meaning prior to the past 2 recessions, and we back tested this for 20 years, this was just bleeding red. There's some concerns here, and we'll keep our eye on it. And if conditions continue to wane up in here, make no mistake, it's going to bleed into the consumer, and it's going to start showing up in the financial stress index. Financial markets, this one's the most volatile. We dropped 7 points, partly because we're getting a little frothy. Advisor sentiment 56.7, above 55 is the red zone for me. This has been a really telling indicator. At the recent top in May, it was 55. At the big top last fall, it was about 60. So it's going in the wrong direction, meaning advisors are too bullish, meaning they're pouring into the market. Get a little bad news, they run for the hills. I almost colored individual investors, that's AAII, yellow because of the very low bearish reading, but we still have below average bullish reading. This is though has been moving in the wrong direction. Another week of that move and this will be at least yellow. So again, one of the best contrarian indicators is individual and advisor sentiment. They tend to get very bullish right before the market peaks and begins to roll over. Short interest looks a little complacent to me. Skew index measures implied volatility on out of the money options. A little too complacent for me. They're a little too confident. Same for the VIX curve, same for the put call ratio. Sectors relative to the SPX, the defensive sectors are doing a little too good, so on. Bonds and so forth. So I could go on and on. The S&P 500 versus the S&P 500 equal weight looks pretty ugly to me, meaning the S&P cap weighted over the last 3 months is really outperforming the equal weight. That suggests that the rally is concentrated in a few issues. You want this green. You want all boats rising with the tide. Having said that, it conflicts with the advanced decline line and the number of members trading above their 50 and 200-day moving averages respectively. In terms of sector by sector, looks good on the 50-day moving average basis, not as good on an advanced decline line basis. So we had pretty good deterioration. A lot of it had to do with frothiness. Oh, and by the way, U.S. stocks look expensive right now, historically speaking. So that's a red. We've had the market melt up to all-time highs, and forward earning estimates are going down. So earnings need to deliver. This coming quarter starts big next week. Expectations is that they aren't going to. However, the bar has been lowered, so we may see a lot of earnings beats. That remains to be seen. My concern is the outlooks. What are companies going to say about about the tariff situation? By the way, folks, that is the explanation up here for this negative number in business. I've been preaching this really since the president was elected, because in his campaign he talked a lot about tariffs. I said he's got a lot of good ideas as it relates to the economy and the market, certainly things the market will like. But if he means it on tariffs, just watch. If he does, if he goes there and he stays there, ultimately that's going to literally kill the economy when it's all said and done. So right now the bears are concerned. My view of the relationship with China, frankly, is it's deteriorating. I pay very close attention to what goes on in China, what goes on in the Chinese media. And make no mistake, they are not in the mood to deal like they were, say, 2 or 3 months ago. I think China has gotten used to the idea that this is going to be a long, drawn out fight. So nonetheless, the bulls still believe that by year end, there will be a deal. Plus, we have the Fed, who's going to juice the market with a rate cut or three between now and then. If they're right, I agree. If the trade deal goes away by year end, I think this market will end the year notably higher, frankly, than even these high levels that it currently is right now. But if we wait too long and some of all this optimism that I pointed to down in here begins to wane, this market could roll over, and in a reflexive fashion, it could start something pretty ugly to the downside. And quite frankly, it could be earnings outlooks that catalyze that over the next few weeks. So I would say that right now, if you look at my index, if you look at it historically, it's not till it turns red that we need to start really respecting volatility. You may recall back in here, this whole time I was very much in that camp that the trade war would go away, and I thought this would actually be the reason it goes away. So I was not bearish. I was not concerned in here, even as the market took about a 20% hit. Everything I was writing on the blog basically just said, we're staying the course. And I showed you a lot of history where you had these kind of corrections outside of bear markets. They were huge buying opportunities. That's how it turned out. The problem is things snapped back too quick to fix the trade war. Up in here, on our side of the table, we don't feel like we need to. So my thesis has always been it's going to be the market that forces a deal. Right now, the market isn't doing that. So if that's the case, it gets more dangerous as we go on. The longer those tariffs stay on, the more deterioration we see in our index. And here it is. As of today, I began the index back in July of 2017. These are just back tests at key areas. So this is what we actually have week after week after week. In a few years, we'll have a real nice line that we can put weekly against the S&P. But this is a trend that we don't like. It was looking better, but you see it's rolled over the last couple of weeks a bit. We're still a ways from zero. We generally don't get defensive until we get below zero. We're looking at getting defensive actually in the meantime, simply because of the prospects for this trade war precipitating a rolling over of the index and the next recession, in my view, a good 2+ years before it otherwise would have come. We really need some inflation. We really need higher interest rates. The Fed lowered interest rates 5 full percentage points in here. The Fed funds rate target is at 2.5%. Fed has more work to do. The economy needs to get better so they can get in a better position to deal with the next recession when it comes. So real concerns out there. I will say though, on the bulls side, I agree that if the trade war goes away in the next 6 months or so, I'm going to be bullish. Although the Fed's going to go away in a hurry. You're going to see the Fed do what it needs to do, because that could bring animal spirits back. Then the Fed needs to forget about cutting rates, get back to reducing the balance sheet a bit, and more importantly, probably get interest rates higher. Of course, that's going to be a headwind for the market. You can really question how much further we can go with all these headwinds. But man, if you look at last week's action, Friday in particular, we just continue to melt higher. Bulls own the day. Is that a capitulation? Is that last round a big rush to buy before we roll over? Kind of like when we look for that capitulation selling on the downside? I don't know. There's going to be a lot to talk about. It's going to be very interesting. Stay tuned, and I will continue to keep you posted here on the blog. Have a wonderful weekend. Thank you, as always, for watching and listening. Talk to you again soon.